So this week we have the return of Karl Griggs.
If you're not going to get the exit that you wanted, i.e. the money out of it, are you better off selling it?
Owner and founder of our sponsors, CPC Finance, top property finance brokers with decades of experience and brilliant people who know the game inside and out.
What you were expecting to draw out, you might not draw out, and how does that affect you long term? You've got to be aware of it. Negative equity only exists if you're selling your property. Don't sell it if it's negative equity.
I was super intrigued to get Karl's perspective on how he sees everything in the property market at the minute.
This time last year, you might have been looking at a 10% deposit, but on the same deal, on the same income now, you're probably looking at a 25% deposit. And you've got to suddenly find that in 12 months. If you go to an auction and you see the bargain, so is everybody else. So the competition on that will drive the price up. If you're looking to make money very quickly, you take a risk. So if you're keeping a property 5, 10, 15 years, it will go up more than any other investment.
Karl, good to have you on. Part 2.
Good to be back. Big changes since last time here.
Yeah, different venue, but good to have you back on, man. At a very important time right now, to be fair. A lot's going on in your world and your industry.
Not just a change of location for you, but change of environment for everybody out there with what's going on in the marketplace.
Oh, is that what you meant?
Yeah, bit of everything, but everything's changed.
Yeah. How's everything going then? How have you finding everything?
It's been very good, good year. There are a lot of changes that are going on, and models of people's finance will change ongoingly. It's very hard keeping up with all the interest rate changes, the criteria changes, the finance changes across the board. But that's our job.
How do you do that? What kind of things do you put in place to be able to do that? Or how could someone else do that if they want to keep up to date with everything?
A lot of it depends on the amount of panels, lenders panels that you're on. If you do a limited market or if you do a full market, then there's a hell of a lot of difference because there's a lot more products available and changes. So it's just keeping market awareness. Obviously, they update us on a daily basis, but it's monitoring and logging it all into the mind so that you're ready to go with the changes ongoingly.
Yeah, how would maybe someone else that's kind of outside of what you do, so someone not generally like a property investor, someone new to it that just want to be updated with information? They
use a broker.
He's a broker, yeah.
It's the best way.
Or even before they want to buy something, if they're just like prepping.
Prep it, do your prep work, particularly if you're going to make a bid, because, and I'm not just talking auctions, if you're going to an estate agent, they want to see agreement in principle. Yeah. So you can get all your groundwork done and then you're free to bid knowing that you've got finance credit back terms behind you so that you've got a firm bid. So you can, sometimes the estate agents will want to see that more than they want to see somebody just coming in willy-nilly bidding and wasting their time. Yeah. And at the moment, an agreement in principle is worth its weight in gold because it's ready to go. Yeah.
But it's hard because how does someone, they don't want to see the people that are kind of just starting out with no experience? How do they kind of get over that hurdle?
Well, there are schemes available for new people getting off the ground.
You guys have got one, right?
Obviously, yeah, we've got one. One type of lending that we do, which is unique for inexperienced people. But there are lenders that will do other products. But you've got to accept the fact that you're going to pay a higher terms day one. But once you get over the first hurdle, the more you do, the more experience, the wider the terms that you'll get, and the better the deal.
Yeah.
If you're on the property ladder or getting on the property ladder for a new person residential mortgage, then you've got to find out how much you can borrow in your circumstances. That's irrelevant, or the actual mortgage you're going to get is irrelevant to the value. Yeah. Because you'll only get a maximum mortgage. Then it's about what property you look for, how much your deposit you've got, but your income and affordability will control your mortgage.
Yeah. Have you seen like a bit of like a fear around maybe more so new investors that you're dealing with everything that's going on?
There is not say a fear, more of a nervousness because you've got to put more money into a day one deal now.
Yeah.
And if you're doing a conversion, there's no guarantee what the exit will be in 6, 8, 12 months time. When I mean there will be an exit, but it might have more of your money tied up than you were originally expecting.
Yeah.
So it might be a different change of business model as you're going along. What you were expecting to draw out, you might not draw out. Now, how does that affect you long term? You've got to be aware of this.
Yeah. So would you say you're more maybe advising people to more flip the properties rather than try and keep them?
That's always your fallback.
Yeah.
If you're not going to get the exit that you wanted, i.e. the money out of it, are you better off selling them? Still doing the job and getting all the money out, but then you won't be getting the rents to go on your cash flow.
Yeah.
So it's a fine line about what works and what doesn't work.
Yeah. Are you seeing many deals that stack up as there were before?
The only big difference is the loan to value on the exit might not get you as much of the money out.
Yeah.
At the moment, it's
a big difference,
it's
or?
early on into that journey, because someone
Yeah.
taking a bridge 6, 8 months ago will only now be coming up to the exit, and it's only really in the last 3 months, 4 months, that this has started affecting the criteria.
So is that the kind of people that's affected the most? The people that have started deals maybe like 6 months ago,
Yeah.
and it's just changed as they're doing.
If someone's doing a new deal now, they'll know what loan to value
Yeah.
they're going to get. If they've done it based on
Yeah.
8 to 12 months ago, it's a different environment and it's a different landscape. So what they were expecting to get out, they might not get out, and that could tie up money. It could be they can't give, say, an investor all their money back. And what are the consequences of that?
Yeah. Do you know that is something that good friends of yours and mine, Sanjay and Malcolm, have always said about the difference between maybe like small deals and bigger deals. It's just the time frame of it being able to get in and get out.
Yeah.
Because the market could change mid deal. So is that?
Yeah, you've got to have you've got to have a fallback, i.e. not be 100% reliant on that one particular deal, or reliant on all that money coming out to move on to the next deal.
Yeah.
You've always got to be able to take into account what could go wrong and what could it cost me.
Yeah. When I say bigger, I mean like maybe like large ones, like multi-let, almost like from the ground up. What do you think about those as comparison to maybe like the HMOs, those kind of deals?
The ground up ones, developments, are purely on experience. So it's very hard to get that as one of your first projects.
Yeah.
The multi-unit, the HMOs, the blocks of flats are where it seems to be going more in favour of. The single buy-to-let market is harder. You're getting you're putting a bigger deposit in, or you're having more money tied up in it because of what's going on in the market, not just interest rates. You've got cost of living, you've got the Ukraine, you've got politics. That's affecting it all. So the affordability and the stress now is affecting the rents. Therefore, it's affecting the loan advance.
Yeah.
Because the lenders are stressing at a lot higher level than they were 6, 8 months ago.
Yeah. It's probably not as black and white as is it a good time to buy property now, because it depends, right, on maybe the type of property, the type of deal. But what kind of advice would you give to someone who wants to invest in property right now? They're kind of sitting on the fence. They're obviously hearing a lot. It doesn't sound great, but sometimes just like the media make things sound worse. People that know the game know where the opportunity is.
I would say at the moment, if you're new into the market, you've got to be looking to gain your experience by doing small project, do it up, flip it. Don't rely on the exit at the moment.
Yeah.
Because that will change.
Yeah.
Particularly if you're new to it. If you've got the experience and you know that, even if we get an exit at 65% instead of 75%, that works for me.
Yeah.
But if you're going to do it and rely heavily on one income, like buy to let on a single unit, you do not know if that's going to be there.
Mm-hmm.
So if you're doing it, buy the right property at the right price. Don't overpay for it. And if you get into a bidding war and do overpay for it, walk away.
Yeah.
You have your limit, that's your limit, and that's what you can afford. Not to lose, but to be comfortable with. And then always work on the exit being a flip.
Yeah.
That's the worst case scenario if you can't get the deal you want in 6, 8, 9 months' time.
Yeah. And what about the selling market? You think now's a good time to sell?
It's a good time to buy, more than sell. You sell if you can get your right price.
Yeah.
There's only, so many properties out there that we were discussing earlier.
Yeah.
If you go to an auction and you see the bargain, so's everybody else.
Yeah,
So the competition on that will drive the price up. So where you might have set your limit at X amount, it might be X amount plus 10% now. Now, you could get caught up in the heat of the moment and pay that extra 10%. Does that work?
Yeah. Do you see that a lot?
You do see it, and I've seen some, crazy prices on auction based on the guidelines. But bear in mind, it's only a guideline to get you interested.
Yeah.
That's not the actual price you're going to get it for.
Yeah.
And some people do think that. But it's a sales tool to get you there, to get you bidding.
Yeah.
And that's their job. Once you're there, if you get carried away and you come out and you think that changes your whole setup, then you probably should have pulled out a lot earlier.
Yeah, you got to be. I think you got to be careful with auctions, right? You got to have a level of experience to go to
Level experience, check the property out, check the legals out, because as soon as you walk out, as soon as the hammer goes down, you paid your 10% deposit, whatever, you're up against it to complete. That's what I'm saying. Have your agreement in principle before you go. Know what your limit is. Get in, get out.
Yeah.
But don't go in there. I've had people go in, buy a property, then ring and say, "Can you get me a mortgage?"
Jeez.
So, there's a right way of doing it. But we can, look, depending on what they're doing, we can help them, but it's just, to me, a strange way of doing it.
Yeah. So obviously, so that's kind of the things we touched on for like investors. But obviously you deal with like lenders daily.
Yeah.
What's the what's the dialogue there with you and them? How are things changing? What are they thinking? Has much change for them? Yes,
because there's new affordability checks, new stress levels, because rates are going up. So what the stress calculations were for many years, while it was at 0.25, stood, and no one not worried about it, but it was never a concern.
Yeah.
Now the interest rates are up above some of those stress levels. They've had to rewrite it, and they're constantly changing the rates, the products, and in some cases the loan to values.
Yeah, but there's no chaos there, is it? Is there?
No, they've all got money that they want to lend, but they're in a business as much as anybody else, which sometimes people forget. They've got to lend money to make money.
Yeah.
For either their investors, their shareholders, and it's not them being greedy, but they're in a business.
Yeah.
Sometimes people think that they're just lending to money just to give someone a great deal. Well, they will if they can afford to do it at that price.
Yeah. But so we're saying that there will be like a lot of deals that maybe they would have done a couple months ago that they won't do now.
Yeah. It's mainly the same product is there. What's changed thing is the interest rates, because the affordability isn't there. And what I mean by that is if you were going to buy a property, on a residential mortgage this time last year, you might have been looking at a 10% deposit. But on the same deal, on the same income now, you're probably looking at a 25% deposit. And you've got to suddenly find that in 12 months.
Yeah.
So it changes. Their criteria hasn't changed. It's the affordability that's changed. And the same on the rents. If you've got a set rent coming in, i.e. on a buy to let, but the interest rate's gone up, so you can only borrow a certain affordability of loan advance. So the loan advance has gone down, but the rents have stayed the same. Yeah.
So what kind of deals do you think lenders are more keen to do now at the minute? What do they like the most? Where you can get maybe the best rates on, the best deals on?
The actual rates have become pretty consistent, and the most and more or less what's the term I'm looking for? They've more or less plateaued together. Actually, there isn't anyone at the moment. No one wants to go out there with a fantastic rate because they know they get flooded with business, and then it affects their service. Yeah. So they're all within the same sort of parameters of where they are on interest rates. It is different because there used to be a competitive market to be the lowest, and now they don't want that. So until it all settles down, and they're pretty nervous about being the cheapest on the market. Yeah. So that's changing the landscape of what they're doing and how they look at things, because The one thing that has been affected is the level of service a lot of the lenders give. That's slowed down. And if they suddenly went out with a special rate, get flooded, it will go even worse.
Yeah.
And then they'll lose the business anyway.
Yeah. Got you. So do you have a prediction of what's going to happen like in the next year? Can you see them going back down? Can you see them going up?
I can only see in the next 12 months interest rates going up slowly.
Right.
I don't think there'll be a big jump. It'll be consistently shallow increases up to about 4.5-5% base rate.
Yeah. I know we were speaking a bit off camera before. Do you see much opportunity?
Look, people that have built a good business foundation and know what they're looking for will make money out of it, because there will be a lot more options there. Maybe not as many people bidding on the same properties, not driving the price up. And also it's how people adjust on their investment side in respect to the rents, because they're going to be getting rents coming in, interest rates going up, cost of living going up, i.e. the electrics and so on. So their profit will be going down. And how do they adjust their business to be successful, to carry on? Because nobody likes losing their net profit.
Yeah. Does this time feel rare to you, or is it something that you feel like I've
been through a few recessions, and each one's different. When we were talking, the 2008 was the lenders had no money, because of the way that it was set up, or securitization, stuff like that. Now with what the government, the FCA have brought in, there's a lot more control on it. They've got the money, now they need to get it out there to make money in that controlled environment. Yeah,
so you're a bit more hopeful for this one?
I think long term, as I said, I think rates will go up, they'll then plateau and then start coming down. Nowhere near down to what they've been. The 0.25 was a false figure for too long. And in hindsight, they probably should have raised it gradually throughout a period of time. And then I think it will then settle down. The new normal might be 3.5% over a longer period. And then everything will adjust to that.
And before you was talking downstairs, you was mentioning that maybe a better thing to do, and the people that are going to survive this the better are people that have like multi-lets, right? They have more than one income in a property. Yeah,
because they're going
to go.
I think it currently is in the environment, because if you've got one rental property with one income coming in, and as I said, if rates are going up and you've got a 12-month tenancy, you can't change that. Then your income's going to go down from it with the cost of living, and depending on what the terms of the tenancy are. If you've got 6 tenants in a property, you've got 6 rents coming in. So you can cover the increases better. The big thing on all of this is to be in control of the interest rates. If you're on a fixed rate, be aware of when it's coming up. Action it in advance of the expiry date. Don't wait till the day it expires, because you can arrange a new product. You could do a product switch to come into force the day it expires. So you might not have a big knock-on period when you're on a standard variable. So you can plan more. Be on control of it.
And as well, would you say it's better to fix a rate at the minute?
You dropped me in it on that.
Too hard to say.
That's a personal opinion, I think, because of you might have a different opinion to me about where you think interest rates are going. I have got some clients that think they're going to go down. So why would you fix? If you think they're going to go up and going to go up for a period of time, 18 months, 2 years, then you would fix. I can't advise what it's going to do. The Chancellor can't even get it right. So what chance have me and you got? It's down to which way you think you're going.
Guys, let's speak jewellery for a minute. Meet Say It With Diamonds, an amazing jewellery company founded by a friend of mine, Charlotte, who you might have seen previously on this podcast. Say It With Diamonds have brilliant collections for everyone, male and female, and for any age. They launched a men's collection recently. They're also engagement ring specialists, and I can definitely vouch for them here, as they did make mine, which was amazing. Visit their website or go over to their Instagram page and have a look. great quality and very affordable, but they also offer bespoke jewelry, as I mentioned, engagement rings and other diamond gifts. On their website, you'll see a member box that you can purchase for £20 for the year, which gives you 1 year's worth of free next day delivery and 10% off everything over £50. Even better, all the Money Game listeners can get a 15% off everything online using the code MONEY15, all in capitals. Don't play games with your jewelry. Get it from somewhere trusted. You kind of give me. I don't want to give your answer because you kind of give me an inclination of what you think, and obviously you know better than me. So, yeah, I don't want to be. I don't want to be. I don't want to say it, and then someone fixes it, and then it goes down.
That's right, but that's where you. It's not so much on my decision.
Yeah.
It's what somebody thinks it's going to do.
Yeah,
if I say fix it and it goes wrong, it's my fault. If I say don't fix it.
Yeah, so you got to just stay neutral.
Because what you got again, where you are at gambling on it, and I don't mean that as in like you go and put a bet on it. Or what I mean is, if interest rates go up, then the fixed rates will go up. So do you go onto a fixed rate now?
Yeah.
Or do you wait 6 months? If the standard variable goes up again, the fixed rates will go up again. And then someone will say, "Oh, why didn't I even go on the rate it is today, not 6 months ago?"
Hindsight, isn't it?
It is, and you know, with the people that are controlling it all, they can't even tell you. So
Exactly.
no one's got these predictions right because it's changed so quickly.
Yeah.
So you have to be careful. Again, it's opinions, and you've got to build in a contingency amount to know that if it goes up, if you're on a standard variable, if it goes up, you're covered.
Mm-hmm.
And then there's always the risk that if it goes up and the lenders change their criteria, you might not get onto a fixed rate.
Yeah. Yeah.
And if you go onto a fixed rate, or at the time, can you get onto it without reducing the loan amount?
Mm-hmm.
A lot of the lenders are really good with product switches.
Yeah.
So, as I said, you might not get more money out, but if you switch your product and secure a good rate for a period of time that you haven't got to worry about, and you realign your business plan, then you can just carry on and leave it alone.
Yeah. Do you know, there's obviously talks about like property being like very passive. Do you feel like with all this work you have to do, it's like that's just false? I think it's got more work than maybe people think.
It could be. Where it's say some passive ones, if you, and I keep splitting the difference. But if you've got multi-units that will reach your levels of funds that you can draw it out and go again.
Yeah.
But if you're on buy to let and you're not reaching your level, you might just have to sit there, put it on a fixed rate, sit there for 3-4 years, and then look at going again.
Yeah.
It all depends on what your portfolio is and what market you're looking for.
Yeah.
So the buy to let ones could just stop, not stop as in get rid of them, just stop taking the money out to reinvest. So that side of it could become quite passive.
Yeah, yeah. Because like you've always got to keep your eye on these things, haven't you? Like you said, you can't wait until your turn comes to an end right at the last day. So something that's got to be constantly worked at. So I mean, in terms of passive, because people think they just buy a property and then they just receive the income like after they've got to do nothing else. You got to stay learning like how you.
You got to stay on top of it and cut out your risks.
Yeah.
Particularly in the current market, if you are reliant on that, then you can't take any risks.
Mm-hmm.
If you've got another income, or you've got a portfolio that can cover it, and you want to take that risk, knowing that you can afford it, that's a different scenario.
Yeah, yeah. But so we speak about property a lot, but I think for you, you're probably obviously. You run your own business. You're more of a businessman than I would say like a property investor. I know you do a few, don't you?
Yeah.
Your own projects. But what's it like just running a business as a whole in these kind of times?
I've learned from the last recession. Don't have any commitments that you don't need.
Mm-hmm. What do you mean, like personal?
No, business-wise.
Business-wise.
Yeah. Well, look, the less you have, the less you've got to worry about. If you have less personal, you don't need as much money, or you don't need as much income. But more. If you're running a business and it's tight, you've got to remember you could have personal guarantees. And if things go wrong, can they get called in, and what's the effect of that? Yeah. So minimalise your risk at the moment. Ensure that you're meeting your overheads quite comfortably.
Yeah.
And if not, cut your cloth accordingly.
Yeah.
they were the things I learned from the last one.
Yeah. What stages were you at in terms of your business for the 2008? Was that early stages?
No, well, we've been 5 years into it, trading on our own, and we built up to quite staff-wise. We was up to about 35 staff, and that sort of disappeared within about 6 to 8 months.
Oh, really?
Down to 4 staff.
Yeah.
Because there were no lenders lending.
Yeah.
You can do a little bit to trade through it, and we did. So you learn from that. You don't necessarily need to do volume business. The most important thing is the bottom line. You could have a £2 million turnover with a £5 profit.
Yeah.
You could have a £100 turnover with a 40 grand profit. I know which one I'd rather have.
Yeah.
And the headache of controlling that amount of staff, and because you're starting the month with a wage bill in 28 days' time of X amount before you've written any business. Yeah. Plus the overheads of the actual building and so on. So you've got to watch. Just because you're writing loads of business doesn't mean you're making a lot of money.
So where did you adapt from there? Because to be fair, the building of your business is something that we actually didn't talk about in part one. It was more just like lending and debt and property. So it'd be good for them to understand the kind of obviously how you got to this point. So obviously you started.
We took the risk in 2003. Started off with some investment and
business partner as well, or just you at the time?
Me and Julie are business partners, and we built that up when things were good. The business was coming in.
What were you doing before?
I'd worked for companies running their business for them, doing the same in the same industry.
Cool. Same industry,
yeah. I've been in the industry 35 years now, so it's a long time. But that's all I've done.
Yeah.
We built it up, and then the recession hit and cut right back to the basics, which was 4-5 staff, including ourselves. And then we've settled at that number, but our volumes have just gone up, and we've had more controlled. As I said, not taking any debt on, and ensuring that whatever happens now, we'll see it through. Yeah.
What kind of things did you start off doing that made you think, okay, that was pretty irrelevant? We shouldn't have done that.
Well, it's looking back now, there comes a point where you could say, right, we've got enough business coming through for the staff we've got. Yeah. If we take on more business, we've got to take on more staff, more overheads.
Right.
Are we going to get that amount of business to justify paying that before you even get to it? And how long is that going to stay for?
Yeah, it's interesting because I think it's a tough one, isn't it? Because normally people are confused, like, should I employ more staff for us to grow, or should we wait for the business to be there and the demand to be there before we...
As I said, I've had enough people say to me, I've got a X amount of thousands or £1 million turnover.
Yeah.
That would not impress me at all.
Yeah.
It's okay, well, what is your net profit?
Yeah.
And if they say a silly figure, what's the point of turning all that money over?
Yeah. It's like me, I could just buy $1 million and these can't I just sell them for $1 million and just that very good. Yeah. So then how did you grow though without taking too many risks in terms of like hiring? And how do you deal with the demand when more business comes in if you've got the same amount of staff?
They work harder. They're rewarded better.
That's tough in itself.
Yeah,
right?
yeah,
managing
we've taken on. We've changed our staff. More things have become automated, so you haven't needed as many staff.
Okay.
We were talking about it in the office this morning, and some of the youngsters can't understand that we used to have a manual diary and paper and stuff like
Karl
that.
still prints his train tickets.
Yeah. I'm still old school, but at least I got it.
Yeah, you did. Yeah. No.
But that's another thing. It's become more automated.
Yeah.
So you haven't needed as many staff. So emails, the way that the documents and way that the lenders are changing as well. E-doc and stuff like that has saved one overheads. Like we used to have to post them out.
Yeah.
And we could be posting out X, Y, and Z a day, which is again another cost that's gone. And things like that evolve, and it will change, and it will change further, and more things will become automated.
Yeah.
That you won't necessarily need that staff, but what do they actually generate? That's what you have to keep looking at.
Yeah.
And then you have less overheads, not just on staff, but on computer stuff. That that has helped. So that will reduce stuff as well.
Yeah. Well, what stage would you say you guys are right now? Are you more of like a maintenance stage, or you looking to then push again? Because I see like you market a lot, like you market really well.
Yeah, but it's the cost of the marketing.
Yeah.
And what that achieves. Going back historically now.
Oh, wait, my dad literally 2 days ago sent me a picture of your sign somewhere. He was like at school. Yeah. And he seen a big banner, and I was like, yeah, he's everywhere.
Yeah, but then historically, going back and to show you the difference, when I was first in the business, a company that I was at, we used to pay to advertise 8x4 advert in the Sun, and it was, and I'm talking 20 odd years ago, 25 years ago, that was something like £5,000 or £7,000 a day.
Jeez.
But that was bringing in a load of inquiries. Now that don't exist anymore.
Yeah.
That type of advertising's gone.
Which one do you like? Which side do you like better? This is more effective for you. Because we had the last episode we had the founder of Reebok, and he was saying how he blew up through a magazine.
Yeah. But it's evolved from there. Now people don't read the magazine, they don't buy the papers, they do it all online. Yeah. So it's having your market awareness on there, and to send out Instagram stuff and so on is a lot cheaper. It's attracting people to your website or whatever you want them, whatever you're tunneling them to, and paying for that to be right to capture them. Yeah. So again, you're reducing your overheads by doing your marketing right.
But it's hard to track, right?
Well, if you've got no business coming in, you've done it wrong.
Yeah.
Sometimes you have to sometimes you have to have a feel for it, and people will tell you that when the way that our business works is once they've made the contact with us, we speak to them. Yeah. So we can find out where they've sourced it from. Yeah. So we keep records on that. Yeah. And that gives us a good. But you get a feel for it. But I'm not a big company. As I say, there's 6 of us, so we have a lot more natural feel on it. Yeah.
But it's all that's like purposely, right? You like keeping it kind of small, kind of tight. Yeah. But
we don't need the pressure of X amount of staff doing and probably making less money. Yeah. The other thing is by having the way we are, we can build relationships with banks, with other sources that refer business into us, so that we don't have to pay for any introduction fee, or there's no cost of that inquiry.
Yeah. No, that's good. And how much you move now was affected by the first recession?
Quite a lot. It's
crazy, isn't it?
And then it's not so much looking forward; it's looking back. Yeah. To think, well, why did we do that? Yeah. Why did we commit to? And this is really old. Why did we commit to a 12-month contract in the Yellow Pages? Because when the recession hit, we still had to pay that. Yeah. And it didn't matter how many people rang us. If there's no lenders out there, we can't lend. Yeah. And you don't make decisions like that again. You learn. And if someone doesn't want to give it to us for a 2-month contract, then we don't need to sign it. So you learn, and you're fortunate, get into a position where you can be fortunate to say, I don't need to do that. Yeah. If you go chasing it and you commit to everything, and that's what I say, you end up with personal guarantees or contracts and stuff like that you're committed to. One, you can be sued, and 2, you can lose everything. Yeah. What kind of like is that the main advice you kind of give to someone who's looking to maybe start a business right now, just not going too fast, not committing to too many things? Don't overcommit, and be aware of what the long term could be. If you do a 12-month, how do you know what it's going to be like in 12 months in this environment? Why sign a 12-month? Oh, it's cheaper, but it's not if you're tied in and you're not getting. How do you know you're going to get the business? Yeah. So, it's a bit like if you go and sign a lease now, you're going to get a rent-free period. On an office. So why don't if everyone rings up and says we can give you 10 leads a day, but you've got to sign this contract. Well, hold on. Why don't you show me you can give me 10 leads a day? Yeah. And then I'll do a contract with you. Yeah. What made you want to go off and start your own business, by the way? I know you're working in obviously another company. I think it was. Don't necessarily have to be told what to do. Yeah. Make your own decisions. There comes a time that some people think, well, I've taken that as far as I can. I want to go off and do something else.
Yeah. Was you good at what you was doing at the time? Was you like really valuable to the company, or was you just like steady?
I thought I was.
Oh, you was. You built your own, right? What?
Yeah, I was running a business for somebody. They were in a position where they could go off and leave me to run it.
Yeah.
So why do it for them?
Yeah, I'd like to know what level like people were at when they went off to start their own business. Because I think that's what a lot of people think about.
It was still a risk.
People think they're not ready all the time. Like it's like a perfect time, but most people I speak to,
there's never a perfect time, because you've always probably 99% of us all got a mortgage and commitments.
Exactly. Yeah.
So there is never a right time, because if it goes wrong, that's what you're risking.
Yeah.
I think the other way of thinking about it is, look, if I go off and do it and it doesn't work out, can I go back and do something else?
Yeah.
And if that's a yes, then you sort of got a fallback.
And what was that for you? Just go work for another company?
Yeah.
Did you ever regret going, like, especially in that 2008, was you thinking, shit, why did I do this?
No, because I'd have been out of job at that other company anyway, because everyone was getting made redundant. So I was no worse off, and able to trade through it and still in it. Some of the people that were there aren't even in the industry now.
Yeah. And what do you think has kind of kept you going this whole time?
I enjoy it.
30 years is like...
I enjoy it now, and it's opened up other things, other avenues. The way it's evolved from, as I say, an advert in the paper to networking, stuff like this. Yeah. It changes all the time, and the way it's evolved as well. You know, when I first came into it, it was first and second charge mortgages for residential. Then it went into buy to lets. Now it's gone into development, HMOs, multi units. Now it's obviously more now is buy and flip and BRR. And there'll be something else next. Yeah. So it's constantly moving and constantly learning. Yeah. And obviously for people that follow you, like see obviously the events that you do, like Savoys and something like that. I guess that's one of the perks as well, right? I mean, it's not a perk. It has to be paid for.
Yeah, it's a paid for perk. But it looks good though. Like.
It's just a different take on it. We sat down and you know my view. I said it earlier. I've been to a few, and one, it's the speakers are the same. They're all doing the same circuit. Yeah. And telling us that they're the best at everything. So I said, look, I don't really want to be not brainwashed, but told that all the time. Yeah. So I think it's better to have a soft approach, and the approach that we said is, look, let's just have a networking where people can socialise, and then they'll come away and say, well, it's all mind games. What they actually do, and then they go and look to see what you do. Yeah. So it's a better selling tool than saying to everyone, well, we're great at all of this. Yeah. Everyone, you know, from my side, most people have got a broker already. So it's capturing new ones that are getting new on the ladder, which is why we've done the lack of experience product. But also, people might go and say, well, actually, I like these guys. Let's see what they can do. And they try us. Doesn't mean they have to stay with us. It's all about service, and we like to think we give it. Yeah.
How's that gone? Because I think the last time you was on here, you had just launched the Game Changers.
It's gone really well. It's got really well, and it's been popular. It's helped people. And from my side, lenders are now interested in doing it. So it can give us more scope with more options. And again, you can play one lender, not play them off against one, but you know, they want the business, then they've got to give you a product.
I really hope you're enjoying the show. I would just like to ask for 1 minute of your time to tell you about my sponsor whose support makes the show possible, CPC Finance. CPC Finance is a finance broker that specialises in sourcing and packaging a wide range of property funding. You name it, from buy-to-lets to commercial properties, auction investments, property developments. They are everything you'd want as a finance broker working for you on your property deal. They're extremely experienced. They know their market extremely well, which means they can move quickly. They're on the ball. They've been in the game for 30 years, which has enabled them to, one, build very strong relationships with a variety of lenders, which as an investor is super important, especially when things don't go to plan. Deals in certain situations aren't straightforward, which is often the case. They are bespoke specialists. And two, they have a brilliant understanding of all types of property investing. They know the strategies, they understand deal structures. There isn't anything these guys haven't seen, you know, they're seasoned pros. So if you're someone looking for property finance of any kind, go to cpcfinance.co.uk, and on the homepage you can schedule in a call at whatever time or day suits. Yeah. And have you seen many, obviously, come on to the Game Changers, do a project, and then having that behind them can then go on and do their own?
They can.
Or still fairly early?
No. We've the only way I can sum that up is we've had repeat clients.
Yeah.
Because they've seen what's involved in the projects, and the main ones that they're looking to do now is the commercial to resi. So there's even more than commercial to HMO. There's more work involved. Mm-hmm. And when they see all the work involved and controlling the builders and making sure the council are kept up to date and stuff like that, they think, for what I'm paying Savoys, I can carry on with what I'm doing and they can do my project for me.
Yeah.
But they've got the option to go off because on paper they've got the experience.
Yeah.
And we've not had it.
Do you see many of the clients that do that? Are they around it a lot? Do they try and learn off it to then hopefully one day go off and do it themselves, or are they more? Do you see most of them just want to be passive? So just do the work.
More of them, I would say, 9 out of 10 have been passive. They've started off and then they've realised quite quickly, actually, I don't need to be down there every week. Yeah. Leave them to it. They get it done a lot quicker, and they do whatever their jobs are. They just get on with what they're doing. Yeah. Is there anything like that you got coming out? Anything else planned? Any new things? Not at the moment, because in the current climate,
you've seen.
I think the lenders they're not going to take new risks on some different stuff. Yeah. We've got a couple of things that we're trying to do, but that's a long way off yet. Mm-hmm.
Yeah. And in terms of like interest rates and everything like that, and just I guess everything in general, I know we were talking about downstairs about how maybe like 2008 obviously was just property, but now it's like loads of different things. We're talking about the war.
Yeah, that's the one main difference is now you've got the environment, energy, you've got Ukraine, you've got interest rates. Yeah. The one thing it hasn't had at the moment is a property crash. And touch wood, that there won't be, but slowing down isn't a property crash. It's maybe a slight realignment to then go again. The ultimate, including 2008, long-term investment in property makes money. Figures have proven it. Negative equity only exists if you're selling your property. Yeah. Don't sell it if it's negative equity. It will come out. If you're looking to make money very quickly, you take a risk. And that risk is that it could always happen. Yeah. But if you're keeping a property 5, 10, 15 years, it will go up more than any other investment in the bank, in ISAs, stuff like that. Yeah. But I guess a risk, obviously, in property, maybe when you're holding them, is maybe interest rates going up too much. There's no profit, but it's control. Again, it's realigning your business plan, controlling it, You've got to have. It's like building a property. You have to have a contingency. Yeah. You have to have a buffer, and look, if you're living on the money coming in and you're not putting aside any of it, then probably that's the wrong idea. You've got rent coming in, you've got expenses going out, you're still making money. It's what you do with that money, whether you have problems or not. Yeah. If you're going to carry on spending on funding the lifestyle, then sometimes you have to cut back. Yeah, no, for sure. What about starting a business? Do you think now's a good time to start a business? I guess it depends. Maybe what business? Any, just in general. There'll be too many to choose. But there's always a risk. The other side of it is that if you look back in the last sort of 3-4 years, all the big companies that were turning volume for small profit, and there becomes a blip, have gone. Who would have thought Debenhams would have done stuff like that? Where it's high volume for low profit, it's hell of a risk because you only need one thing to go on and it's wipes all your money out. Yeah. So it's making something with low investment but a good return. Yeah. What about lending in terms of like lending your own money? Do you think that's a good play? Because it's something that I hear a lot of people talk about. Lending money, but this goes back to what we've been through. Yeah. If you lent money from 2012 to 2022, you should have made money. If you haven't, you're in the wrong business. But Now we're in a period where it's very easy to lend money, but you've got to collect it. And if the refinances or the exits that people were going to repay you with aren't there, how do you get your money back?
Yeah.
It is I know it's a strange saying, but it's the truth. Easy to lend money, harder to get it back.
Yeah.
I'm the world's favourite client the day they complete.
Mm.
Day after they complete, they have to think about paying it back. I'm not so popular.
Yeah.
I haven't done anything different, but that's human nature.
Yeah.
Up until your day you complete, they want to know me. After that, then it's gone.
Mm-hmm. What would you say? Like, was it a lot of? I'm guessing you've had like clients from way back, from maybe like even when you started.
Mm-hmm.
What would you say like some of the traits are of the people that's like weathered everything? What have they done differently to the people that have gone bust and have fallen out?
They don't go too big. You know, what I mean by that is they don't jump from a 3-bedroom house to 24 bedrooms and try and go too big. They gradual increase, or they stick to what they don't know, and that's what they're happy with. You know, we've got clients that have got all different setups. Some just like small value buy-to-lets, which, you know, in the current environment still make money. If you're right up north, then you've got a low value property, but you're getting a good rent on it, then what investment risk have you got?
Yeah.
Whereas if you've got a 3-bedroom house right up north that might be 60, 80 grand and getting you £800 a month, that's still really good.
Yeah.
If you've got a 3-4 bedroom house in central London,
different story.
And you've got all your money tied up in it, and the rent's going down or the costs going up, there's a massive difference, because you're probably only getting, like if you're in sort of North London, a 3-bedroom house, probably getting 2.5 grand a month.
Mm.
But the maintenance and the size of the mortgage on it will probably be 300, 400, 500,000.
Yeah.
So the actual change for the amount of difference in the rent is considerable.
Yeah. Have you seen many people maybe that have gone bust back then in 2008 come back just like incredibly stronger, or just?
Yeah, a lot of them have, but again, you don't know what's going to happen now.
Yeah.
As I said, from 2012 to 2022, if you're in the property, you should have made money.
Yeah.
I haven't, you know, the ones that overcommitted and bought too big a sites, then that's a different scenario. But you know, a bit like the builders have all gone round again.
Yeah.
Okay, some of them will have bad credit and whatever historically, but they traded out of it.
Yeah. Have you seen the film Big Short?
No.
No, you've not seen it?
No.
Oh, it's just a film that about the crash in 2008. And it's just crazy. I just wanted to know, was it actually like that?
It was instant. It was literally, we got phone calls in an afternoon to say, we cannot fund any of your deals anymore.
Was that a huge panic?
Yeah.
What was like your mindset at the time?
What are we going to do? We got clients that were due to complete that day.
Yeah.
And move. And not only had the mortgage offer out, we had to tell them you can't complete.
Mm.
And we had obviously a pipeline of business that we'd paid for, i.e. advertising, processing, overheads. That was never ever going to, and that commission was our pipeline. We were never ever going to get that commission.
Yeah. Obviously, that's why you went from how many to 35 to 4.
Mm-hmm.
Was that, I guess that was crazy stuff yourself, right? Just having to, to let go
it's
of people.
stressful. I wasn't great then. But it's stressful, and you've
business,
got
right?
It is. Some things are out of your control.
Yeah.
And again, you know, when you were trading like that, we were trading, making money, but not enough money to sustain it. Mm-hmm. It's different now. We're in a different position. We haven't got asset finance. We haven't got big offices where we're paying stupid rent and service charge, because everyone thought it would last.
Mm. Yeah. Do you think you'll ever go to that stage? Never?
No.
No matter how big you used to ever get?
No.
Really?
It's not worth the hassle or stress. Yeah. As I say, to achieve what?
Yeah.
If you're happy with the money that you're making, or and it's giving you a certain lifestyle of living that's comfortable for everyone working for you,
why would you take the risk?
Why take the risk?
Yeah, but that's obviously from your mindset now, but that's not necessarily what you thought back then.
But it's what you like. When I went on my own, I've been used to a certain at the old company, and that was our mindset. We used to work 9 till 5:30, 5 days a week. Work on the Saturdays. We'd have an evening staff to cover the phones in the evening because people were still ringing, because we didn't have mobile phones weren't like that then. And so, as I say, all of that's changed. You don't need to do that long. And if people want to ring in the evening, we give them our mobiles. But you don't have to be sitting in the office wearing yourself out. Do
you know when you're talking about having a certain lifestyle and having a level of comfort with the people around you, for an owner of a business, how much like responsibility do you put on yourself for like the people that you employ in terms of like you pay their wage right and on how to live? Is that something that's like on your mind daily? I think a few people on this podcast have spoke about that.
Someone years ago gave me some advice, which is pay your staff well and look after them, because you don't want them sitting there having to worry about going out and get a second job. Because they're not concentrating on the work they're doing.
So does that weigh heavy on you?
Not heavy, but it's a two-way thing. If you give them,
but I mean, you've always got to maintain a certain income, right, to be able to pay them well.
But that's what your budget and forecast and stuff like that's for. But if you give them a good income and perks and stuff, then you want to return for that as well.
What kind of things would you say you do? Obviously, other than that, you mentioned perks. What do you do to keep people motivated and to keep them working and to keep them happy? Because that's the thing.
Well, again, they get to good environment, good hours, incentives. We wouldn't and we don't do individual bonuses because that throws one off against the other, and there's no bonuses.
Just keep it together.
It's all. If the company do well, everyone gets it. So then it's just because someone's in sales and someone's in admin, obviously the sales look like they make the money, but they can't do it without the admin. Because I've never met a good salesman that's any good at admin. And I've always said, if a salesman doesn't cut corners, then I'd worry. And then it's the admin people that put the corners right. And they work as a team, so one's got to go with the other. So you need to make sure everybody's in it together. So there's no us and them in it. Ensure that they, say get on. You can get one person that could upset the whole apple cart, and we have had that.
Have you? I was going to ask that. Have you?
Yeah, we have. Yeah.
The 6 people you have now, they've been there for a long time.
One's been with us quite a long time. The other 2 are younger, 3-4 years. So it's changing it. Well, we changed it around. We evolved. You evolve with them and take on a different background. We brought people in that had estate agency experience or selling experience, not necessarily finance experience.
What's that process like in terms of hiring people? Because like you said, if you get that one wrong,
I can't say it's something I like, but because you got a CV, everyone can do a sales job at an interview, but it's getting down to knowing how they're going to get on in the environment. Are they going to fit in?
What would you look for? What's your process like?
I personally,
what's any red flags?
I personally go on first impression and personality. And then, okay, have they got everything else that you need? You can get someone overqualified or fully qualified, but if they can't sit and sell you anything, what they're going to do? And how many jobs they've been into, how quickly.
Okay,
they're moving around every 6 months, every year. Why? So there's a number of things.
Nice. Well, without your
and then actually 2 that are with us, we've approached them because we've seen something in them somewhere.
It's in like just them working from a distance. You've seen them in another company.
So, selling something and I thought, well, if you can do that face to face, you might be able to do something for us.
Yeah.
Doesn't necessarily mean you have to be in the same industry to start with, because there's other jobs that without the qualifications that people do, i.e. the admin or stuff like that, and then they can train onto it and train it and our way.
Yeah.
Rather than someone that's been taught a different way to how we work, we have to retrain, not train them, but we have loggerheads about switching them. Well, we do it this way.
Yeah, no, that makes sense.
It doesn't always fit in.
Yeah.
You must have it. If you get a coach that trains you one way, it gets the boot, and a new one comes in, trains you a different way. You're thinking, well, which is the right way?
Yeah. So was that thing where we look for more younger employees at times then? Because they've been less conditioned.
Yeah.
Mm.
And it also brings an energy to the office.
Yeah. Got you. Throughout your let's say your business life, what would you say is like the biggest risk that you guys have taken? Doesn't sound like you've taken loads. You've been very like conservative.
But no, we took a risk going out on our own.
Yeah.
In 2000,
what were Julie doing as well at that point?
She was trading on her own.
Okay.
And then we joined up and done that.
Okay.
The other thing was in 2008, probably should have gone bankrupt.
Mm.
Didn't know anyone a penny, but everything would have got called in.
Yeah.
So we traded through it.
How did that happen? How did you keep your head above water at that point?
Used credit cards, used money from family,
used
all our savings, but didn't not pay anybody.
Yeah.
So that was a good thing.
Yeah.
Purely because if they had called in, the bank had called in the personal guarantee, we'd have lost the houses anyway.
Mm-hmm.
So it's the one thing we didn't want to do. And we borrowed money off people, we wanted to pay it back, which we did.
Yeah.
So that was a risk then. We could have and should have, like a lot of people, done that. But that would have affected us now because, we traded through it and we didn't have to reapply for FCA authorization. We was carried on, just things like that, and we didn't have to apply for new agencies. Yeah. We got through it.
Yeah.
So that sort of it was still a risk, but meeting everything every month.
Yeah. So you say starting out was the biggest risk for you?
Yeah, when you go from a guaranteed income, PAYE, that meets your mortgage and looks after you.
You have a family at the time as well?
Yeah. To starting with nothing, not knowing if a deal's going to come through the door.
Yeah.
It's a risk.
Yeah. What were the people around you like? Were they supportive, or was they like have reservations about it?
No, really. It was a joint decision with me and Julie, and we decided that go for it and let's have a go at it.
Yeah. What would you say your biggest win in business is? Biggest achievement?
Still being here. Yeah.
Oh yeah, that's not bad.
Yeah, it's 20 years down the line and we're still here and in a position where we can go forward. So, that's the most important thing. And hopefully, we'll carry on like that. Maybe not see another recession. That would be a nice thing.
You're recession-proof now, yeah?
I wouldn't say that. No one is, because no one knows what's around the corner.
Yeah. It could be this year.
There could be changes in the financial market that stop people borrowing. Silly things could affect it. You just don't know.
Yeah.
But from having a stable position, if something like that didn't happen, then fine, going forward.
Yeah. And you guys feel like quite versatile as a business? Because you're small, right?
Yeah, you get trends. Again, listening to people, like the networking, and you get a feel for what's new. Like 2 years ago, no one knew the term BRRR.
Yeah.
Well, that's evolved. So
is that how new it is?
It's new as a product. People were doing it and flipping.
But it wasn't a
But
thing.
they weren't really doing and converting to multi-units and getting the rental.
Yeah.
But Resi to HMO is a relatively new market. It was always there, but obviously legislation and licensing is getting bigger. Mm-hmm. So that market is a newish, relatively young market.
Yeah.
And then from that came the real, the term BRR.
Yeah.
And there'll be something new. There'll be another way of doing it. What it is at the moment, don't know, but it's listening and jumping, not jumping on board, but listening so that you're ready to go with how then funding needs to be done.
Yeah, yeah. Just through socials, I see a lot of like young entrepreneurs, young property investors. Just like they come to obviously the events that are clients of yours as well. How do you feel like they're doing? Do you think they're on the right track? Do you think they got the right idea?
I don't know their personal circumstances, but they all appear to doing well. Yeah. The only thing I would say from experience is they haven't gone through what's coming up.
Yeah, I think that's when you find out
Then you find out the good ones.
Yeah.
And it's not horrible to say, but it is going to be a learning curve.
Yeah.
Some people will stay in it, some people won't. And that's where we're going to see the good to the bad ones.
Yeah.
And it will happen.
Yeah.
It affected 2008. It affected broker market. A lot of brokers packed up and went. You've got the problem now, not the problem, but the similar thing with valuers, with the PI cover and their premiums and stuff like that. A lot of them are either getting out of the business or buying into a bigger company, and only purely because it's not worth them carrying on like they were. And I think this will happen because don't forget, some of the new generation have only ever known interest rates 0.25.
Yeah.
When they are like in their adult life.
Yeah.
And there's a hell of a change.
And
the good ones will get through it.
Yeah. And to wrap up, what would you say is your core life and business philosophy? The kind of thing you go by on a daily basis, almost.
It's trying to deliver the service for the people that use you. Because if they're happy, you're happy. And it's trying to make it as smooth running as it is possible for them. Yeah. As I say, if they're happy, they'll grow, and if you're involved with them, and you give them everything that they want, that they don't have to go somewhere else, you'll grow with them as well. Yeah.
Also, what drives you, would you say, on a daily basis to work?
I enjoy it. Every day is different. Every application is different. Every property is different because there's always someone doing something different to it. Yeah. So you never see the same thing twice.
Yeah. Which side of it do you like the most? Is it more like the people side? Is it more like the property and figuring things out, the deals, the numbers?
No, the property side. The property side is the people, because it's the people that are doing the property. Yeah. It's what they're doing with it. They come to you and say, "We're going to do this," and then you see that all the way through. I do the finance stage 1, and I probably do the finance stage 2 if they're keeping it. So you see that, and then you see, right, well, I've had clients that came to me with 6 properties. Now they've got 24, 30.
You must see a lot of growth, don't you?
Yeah.
In terms of portfolios.
I've been working with Savoy for 10 years, so their portfolio,
exactly.
And they've changed. They've changed now into the commercial to resi market. I've got others that have stayed building small buy-to-let portfolios, and their numbers have gone up. Yeah. And it's being able to say to them sometimes, that don't work. We're not going to get that. So it's relationships.
Yeah. No, I love that.
Yeah. Excellent.
Oh, brilliant. Thanks for coming on, man.
No
part
problem.
2, part 3 pending.
Yeah. Come back next year.
Yeah, we see actually it will be a good part 3 because probably when we end up doing part 3, we'll get some of the answers that we're talking about today.
Yeah, maybe 6 months' time, see how it changed.
Yeah. No, I love that.
Excellent.
So, thanks so much. Thank
you.
All right.